that has had this panel, and all of you still look great after all these years. So let me turn things over to Mike and to Ira, and thanks for joining us.
Thanks, Bob, and welcome everybody to the Investor Roundtable. My name is Ira Weinstein from CohnReznick, and it's my pleasure, along with Mike, to welcome you to the final panel of the day, at least the final full panel of the day. And it has been I think, an incredibly exciting day. We've heard a lot of great things from a lot of different people. I think that bodes particularly well for where the program is headed. But we know that there's a tremendous work ahead of us, and a lot of things to do to make a bigger difference in disadvantaged communities. While we are closer to permanence than we've ever been, and while we may be on the heels of an expansion and extension of the program, there are some real challenges ahead. And I think that certainly being on Zoom, we all recognize that we are still in a public health crisis. We hope we're turning the corner and things are getting better, but that's not necessarily the case in all communities, particularly disadvantaged ones. So there's still a lot that has to happen. And obviously trying to do that with I'll call it a tremendous legislative initiative in front of us, which I will say is unprecedented. I think we've probably said that many times in the course of these convenings over the many years of the New Market Tax Credit Program. I think it's been true in each case, but it's also more true now than probably it's ever been. And so as we think about what is in front of us, as we think about the legislative initiatives that are being considered, that are the basis for a sustainable and equitable recovery, and as we think about all of what that can do for disadvantaged communities, I think the spending side of the legislative effort can be very, very impactful in a positive way. But at the same time, there are all kinds of economic factors that can be triggered and that could be challenging in their own right. Obviously, tax policy will play a big role in what the legislation looks like and the effect it has. And while there again, I think there are a lot of pay-fors that could bode very well for the tax credit market and therefore disadvantaged communities, a lot of that remains to be seen. And so a lot of hard work ahead of us, and critically important that we hear from investors. We do have 3 great ones that make up a large percentage of the marketplace. We would have had a 4th, but Lee Winslett is under the weather, so we will miss him. But I thought we would just give a quick intro from Laura, Steve, and Dave, and then we'll turn it over to Mike to sort of tee up the discussion. Laura?
Thanks, Ira. Can you guys hear me?
We can.
There's a little bit of a echo.
It sounds good on this end.
Okay. Sorry, Ira, thank you. I think that might have helped. I'm Laura Vowell. I'm the Director of Business Development for U.S. Bancorp Community Development Corporation for historic and new markets tax credits. We are also an 8-time allocation winner with USB CDE. I apologize. I got to figure out what's going on. It's echoing directly into my ear. Can we go to Dave and I'll come back?
We can go ahead and go to Dave and then Steve, and then I'll set the stage. And then by then, hopefully the echo will be addressed.
Hi, everybody. Dave Gibson with PNC. I manage PNC's new markets and historic tax credit practices. We, like US Bank, are also an allocatee, and we have a national footprint operation. I sit, for those of you that don't know me, I sit in Pittsburgh, and we have teams of folks sort of scattered throughout the country. Happy to be here today. Thanks for having me.
All right, Dave, I'll go next. Assuming you guys can hear me, this is Steve Ross. I'm the New Markets Tax Credit Program Director for Truist Community Capital. Would be the Historic Tax Credit Director as well if we ever get back into that business. Stay tuned. We are also an allocatee, a 10-time winner. Don't look for our name this round because we didn't apply last round so don't look for us in the award book, but we are an active investor nationally, but tend to focus most of our investment in the Mid-Atlantic and the Southeast, where the bank's primary footprint is for Truist. And I know we always say these things, but I am speaking on behalf of myself, not on behalf of the bank. But since Lee's not here, I'm happy to speak on behalf of Wells Fargo. So, no, but in all seriousness, thanks you guys for having us today, and I appreciate everybody's time.
Great. Thank you, Steve. I don't know, Laura, if you wanted to say a few words or.
Let's see if this is better. I think this is better. Can you guys hear me?
Yes.
All right, great. So I'm Laura Vowell from US Bank, Director of Business Development for New Markets Historic. We're an active New Markets Historic, renewable energy, low-income housing, tax credit investor. We're a lender into New Markets transactions and to CDFIs, and we are an 8-time New Markets allocatee.
Great. Thank you, Laura. Thank you, Steve. Thank you, Dave. And thank you, Ira. I just wanted to share a few thoughts about framing the discussion with our investors today and have them sort of weigh in. And as you see on the graphic in front of you, I'm not sure in the 20 years that the New Market Tax Credit has been in the tax code that it has been quite as dynamic a market when I look out into the future and all the various variables. And I thought we've been dealing with the COVID crisis and the impact that has had on the demand for tax credits more generally, and New Market Tax Credits included for the equity investments there. And I thought it'd be useful just to talk about some of the factors that when we look at where we are now and then look into the future, as we try to make some sort of assessment as to where the equity markets and the demand, investor demand is going, just to think through the variety of factors that are working to impact equity pricing. You know, some factors we know directionally would generally be positive. We know some factors that directionally would have an adverse effect, and then some we're not quite sure what impact they would have. And that's how as we look over the next 12 to 24 months, these are a lot of the factors that will be weighing in. And this is not an exhaustive list. And as we had the discussion, others can sort of weigh in terms of what's impacting their near-term demand and what they think demand over a longer term might be. And I'll start maybe in the lower left quadrant about the corporate tax rate. President Biden has come out with his plan, and to no surprise, he did in his plan propose a 28% top corporate income tax rate, up from 21%. Many think that he couldn't be successful in getting that through Congress. There are some members of Congress, particularly certain key senators in the Democratic Party, that have suggested maybe a top rate of 25% is what they would be comfortable with. But there could be this increase of the corporate tax rate from 21 to 25%, which all things being equal would lead to greater tax liability, such that you would think that that would lead to greater demand. But obviously all things are never equal, but that's one potential factor out there. I'll also note that there is the potential for a book minimum tax. As we heard earlier from Beth Bell on the Ways and Means Committee, there is some resistance among some members of Congress on having some type of corporate tax based upon the book income of a company, because then some portion of the tax revenue is now based upon rules that the Financial Accounting Standard Board determines. But if there was such a tax, then the question would be, how does the New Market Tax Credit and other tax credits offset that tax? So that's another factor. And then there's also the potential replacement of the BEAT, the base erosion and anti-abuse tax, and other international provisions that also could have an indirect effect within the corporate tax environment on demand by corporations. And then there's, in addition to that legislation, as you go to the left and you see future legislation, there's discussion of increasing low-income housing tax credits by $55 billion with a B, creating new tax credits like the Neighborhood Investment Act, a tax credit for single-family home renovation and construction in distressed areas, and a number of other tax credits out there, expansion of renewable energy, clean energy tax credits, which obviously if there's a supply of tax credits, that'll have an influence. I will note that there is talk of direct pay, and that would with respect to clean energy tax credits, where rather than claim the tax credit on a tax return, the partnership or the entity entitled to the credits could actually just get a refund of those taxes, which would have the inverse effect of maybe creating more tax credits, but also reducing the demand for tax credits because they're going into this direct pay route. So that could have an interesting impact. We've talked before about trying to get an expanded carryback. The status of that remains to be seen, basis adjustment, as well as potential for AMT offset, as Bob noted earlier today, how the AMT offset wasn't in the president's plan, but it is something that is part of the New Market Tax Credit Extension Act, really the Permanency Act. And it is something that if the AMT offset were to be allowed, then individuals could be more significant investors in the new market tax credit space. And that would obviously bring in more investment and could help on the equity pricing side. Kind of going around the horn here, I'll go quickly. The interest rates, obviously, if interest rates rise, then equity pricing is adversely affected by that. Once again, all things being equal, but interest rates also might create more profits potentially, depending on how they're within the banking community. So maybe that leads to more demand because there's more taxes. Obviously, how the overall economy does, have a big impact, as we saw with COVID and the impact that had on investor demand as they were unsure what the near-term economy was going to be. Also, the Community Reinvestment Act. I think last year, before the election results, there was a lot of concern about whether or not the Community Reinvestment Act would be changed in ways that would disincentivize or at least reduce some of the level of incentives for investors to invest in new market tax credits. Given the current administration, I think most expect that fear isn't quite as great. I will note that there has been discussion within this administration to even expand the application of the Community Reinvestment Act to insurance companies, maybe beyond, such that if there was an expansion of the entities that Community Reinvestment Act could apply to, there could end up being even additional demand created through the Community Reinvestment Act expansion. And then additional factors is obviously, we'll let some of the other panelists discuss some additional factors. And then gap accounting, I did want to make sure that we noted gap accounting. I think everyone knows it's public that PNC did submit a request for gap accounting guidance from the Financial Accounting Standards Board to basically get the accounting bodies, I should say, to provide better accounting for the new market tax credit. I won't go into all the details as to the adverse effects of that accounting, but it is impacting investment. I will say the gap accounting change isn't something that's going to happen very fast. So it's not something that in the near term is going to have a dramatic influence, but it is something that if we could get that change, it could have a notable impact on equity pricing. It did have a notable impact when the long housing tax credit received favorable guidance. So that's what I wanted to share in terms of the key factors that all of us should be thinking about as we're talking about equity pricing, and knowing that there is, this variability going into the future. And as some of these issues get resolved, we'll have a better sense as to where equity pricing is headed. But with that as a kind of a lean in, I don't know, Ira, if you want to say a few more words, or if we just want to jump into Dave, Steve, and Laura to address where they see equity pricing right now and how they see these various factors influencing their demand.
Yeah, I'd love to hear from all three of them. I think we have clearly never seen this many externalities, and clearly for banks, for financial institutions and other institutions, there's always competing interests. So what might be good in one instance may not be in another. So let's dig in.
So Dave, Steve, or Laura, whoever wants to go first.
Well, I mean, I'm happy to jump in. I mean, I think one of the things that I'll add to the pile. I mean, I certainly agree. It's never had I can't remember having a harder time being able to predict what will happen sort of this close to an award announcement, and sort of, what will happen in the immediate wake. My gut would tell me we're seeing an uptick in pricing. We're obviously one of the things that I don't think we covered in that long list is a 40% increase in supply of new markets coming all of a sudden, right? So that's certainly a factor. But to me, always the biggest unknown, no matter how long the list of factors is that there's still, although that the investor pool, I think, has expanded over the last year to 18 months. There still are very few of us. And so any one of us having an individual story can have a pretty drastic impact on overall demand and pricing. And I think that I mean, we've got to keep an eye on that, right? On top of all of these things that you could predict and come together and bring together, sort of any one situation can really influence things.
Yeah, and you touched on a lot of things here, Mike, about various pieces, future legislation, interest rates, et cetera. I mean, what I would tell you is that from Truist Community Capital's perspective, we huddled up, right, as soon as this proposal came out, and we started looking at the various proposals on future legislation and trying to think which of these are priorities for us. And the truth is, a lot of them are, right? Obviously, it goes without saying that we support new markets tax credit permanency. That's like number one on my list. Number one on the list that we sent over to our legislative liaisons at the bank, and they have been proud supporters of new markets tax credits no matter what, right? Even with corporate tax rate discussions going on, they are very, very adamant that new markets tax credits, low-income housing tax credits, and other credits, including renewables, historics, et cetera, are critical for community revitalization. And a lot of these programs are just consistent with what Truist Community Capital and others on this call have been doing for decades, right? And so there's a lot to like here. Some of the things that impact pricing specifically, obviously CRA for us remains a critical factor for Truist. I mean, we're in our first ever CRA exam cycle as Truist with the FDIC. And so, we're hard and fast focused on making sure that we do a good job on that. So that's playing a role in where we focus our attention. Pricing is obviously impacted by demand. I think that I'm probably, again, this is Steve Ross speaking, not Truist. I mean, I'm one of, 15 people out of 54,000 that's going to be super excited if the corporate tax rate goes up because it means more business for us, right? Everybody else at the bank's going to shake their head. But the reality is that that's a factor, but there are so many others. I mean, we've reviewed and talked with Dave and the folks at PNC about the gap accounting feature. I mean, that's really important. That's something that impacts all of us as investors, and it's something that shouldn't be glossed over. And I know we're going to talk a little bit more about interest rates and things as well, but, cost of funds is a factor. To me, though, at the end of the day, I mean, I think that a higher corporate tax rate will ultimately have some impact on pricing because there will be ultimately, there's going to see more demand, and particularly in those markets that are heavily CRA focused as they have always been. But I will tell you this, I echo what Gabe said, as the program continues to grow, it's important for us to find other investors that come in here and help. And it may be strange for us to say that, right? For all of us to say, hey, we want more competition, but I think it is healthy for the industry. I think it'll allow us to be more successful, the more professional industry groups that we have focusing on new markets tax credits. The more people are going to be joining these types of panels, putting their weight of their organizations behind it. So I look forward to seeing other institutions jump in and play a bigger and more active role in the new markets tax credit space. And I think that Dave and Laura and others, including at Truist, we're actively bringing other people to the table to get them involved with new markets tax credits. And I think that's a really important part of the future of this industry is attracting other investors.
So the one role that I forgot for U.S. Bank when I did my messed up introduction was probably the most important, which is as a tax credit syndicator. And so that does give us the perspective of more than one institution. And I'll kind of give you where we are today, maybe where we were in 2020. I would say in the third quarter, our appetite was limited. We had probably originated about what we wanted for the year, and we really needed to do something to have a substantial opportunity to invest in more new markets credits. And we were able to close a $500 million QEI syndication at the end of 2020 and fill that with lower tier closings and pre-funded QEIs. And that was kind of the first big step for us to really open the syndication market for new markets. It had been relatively limited. A lot of the buyers are also, direct buyers or had been direct buyers and were pulling out of the market for various reasons. So seeing new entrants with a big appetite into new markets was helpful, made us feel good. We still came into 2021 with a relatively small appetite because we didn't know that we just hadn't proven yet that we could have that same success again this year. Since the beginning of this year, we have been able to secure or identify another kind of large chunk of appetite similar to what we did last year. our syndications to our existing syndication partners. So this is broadening the pool of investors to those that maybe previously only had an interest in LIHTC, but now are adding new markets because their appetites are greater. And that's kind of the mix of opportunity that we have, or new markets happens to fit their needs at this time. And then the bank's appetite has been a little bit more robust than I think we were expecting. I think the economy is kind of, we're seeing it come back a little faster than maybe we were thinking in the third quarter of last year. So our appetite is significantly stronger. I think the key for that remains pricing, and all of these factors then go into the pricing, and what any one of those investors, which is exactly what Steve was saying, any one of us are, may change our appetite if one of these features or factors changes so significantly, or maybe it changes the appetite of our syndication partners because they have other investment opportunities that are similar. So that's what we're looking at, kind of that broad spectrum of views from a syndication perspective.
And Laura,
yeah, and I'll say one more thing really quickly, Ira, which is that,
Sure.
We are, from our perspective, doing more in 2021 than we did in 2020. And I've said this before, Truist Community Capital probably closed almost exactly half as many new markets tax credits by volume, QEIs, in 2020 as we had done in 2019, right? That's how big the impact was. We cut our activity in half. We're going to do a lot more in 2021, and we actually expect to see that grow. So for everybody out there, the future looks good. I mean, we're adding resources, and I think you can look across the industry. I mean, this 5-year extension is you're seeing it in waves, not necessarily in pricing yet because demand is a factor, but what you're seeing is a lot of investments in personnel. You're seeing a lot more investments in trying to find other investors. And a lot of these organizations, including our own, are saying, hey, we can add more resources, which is really key.
So I want to just pull in a thread there that you guys touched on this whole notion of absorbing supply. You talked about the need to address that with increased demand, which could come from competition, and you're essentially welcoming that. I'll use that word. And then at the same time, Laura touching on the need to create a more liquid and efficient secondary market, all of which are great things to sort of carry us forward. What about the internal competition? As you think about the other tax credits that are out there, either new tax credits or an increase in existing credits, talk a little bit about both the internal competition from the perspective of what impact, if any, on your demand, but also the way in which the institutions sort of approach that. So you guys are effectively, hopefully, working with colleagues that may not be focused on this credit, but other credits, some of which could be combined with the new markets. What does that framework look like for you guys? And is it different going forward than it's been? Anybody want to grab that?
I'll start with that one. I think similar to the syndication platform giving us flexibility, we are active in all the tax credit markets and see the differences. There are positives to accounting related to new markets, and there are negatives, accounting and tax benefits, and there are negatives. And so there's a puzzle that gets made between transactions and investment types that derive one type of tax benefit or cost and those that offset it. So we will always kind of have that puzzle nature, with syndication being the release valve for us. But I'll say for new markets specifically, and the competitiveness of that credit is put up against the low-income housing credit, and the gap accounting treatment is not in new markets' favor. And so that always will be the case and will always limit new markets' appetite, which is what Dave has been pushing for. And I think he can tell an even stronger story of that. The last thing I'll say is new markets tax credits provide a type of community development incentive that I think the government, we heard it all day today, the world, community development is kind of the focus right now, and new markets is going to be an important part of that. And so as a financial institution, we will continue to invest in new markets because we want to support all aspects of the economy in that way.
Yeah, just jumping on that. I mean, our and also picking up on the thread of an example of any individual story can have an influence. And at PNC, our tax credit businesses, most of our tax credit businesses are together on the same team. And it is, Laura described it really well. It is a constantly sort of evolving puzzle and moving puzzle that we're trying to put together, where it's constantly trying to find the right balance of what we want the portfolio to look like, both from an overall perspective in the generation of credits, but also among the varying products. We have a very robust housing credit syndication platform. And so that is our biggest tool in being able to manage sort of how much, by way of just sheer consumption of credits, PNC has. We're really able to really efficiently come in and out of positions. As our housing credit portfolio is much bigger. Of course, it's a much bigger program, right? But it's a much bigger portfolio than our new markets or historic portfolios, and our the syndication, that syndication platform is being leveraged a bit now on the new market side to help to provide some flexibility for us there as well. But that's in its infancy. But at this point last year, just as an example, we were a net seller of credits. We were in a position where the bank really didn't have the appetite, and then all of a sudden PNC sold its interest in BlackRock, and literally overnight we went to a net buyer with a very large appetite for credits. But it didn't really alter our appetite for new markets for our portfolio, really largely driven by the GAAP accounting treatment on the new market side. So that's just sort of sharing the way that sort of an individual story can impact demand. And something can change in a heartbeat, really. Right?
Yeah, absolutely. And I would agree. And the conversations over the last year and a half, I mean, we already knew that. I work alongside all of our LifeTech investment partners at Truist Community Capital. Our renewable investors are in the investment bank, but we know them very well. There are not that many people at the bank that specialize in tax credits. We know each other a lot better now, right? And all the people at corporate tax, all the people in accounting policy. I mean, we've always had regular conversations. We're now having very frequent conversations because as we manage, we've always forecasted things, but it is a balance. It's a puzzle. Use whatever analogy you want, but the reality is that there are advantages to new markets and there are disadvantages. We've highlighted the disadvantage on the accounting treatment a couple of times. But the advantages also can't, I will say this again, it's doing something that no other credit does. And, we've seen real impacts with the jobs, the healthcare, the education, the access to healthy foods. I mean, we're all telling stories. All the CDs, all the investors are telling stories in these communities, and I think that's why the bank, no matter what the appetite is going to look at this as something that's key for our clients and for our communities. It's also innovative use for CRA, so it's going to get scored well. I think there are a lot of reasons why we will continue to do new markets tax credits, regardless of the economic situation. If the economy goes badly, that doesn't mean we're going to be doing no investment. It will impact it. But I think to Laura and Dave's point as well, it's nice to have a safety valve too. It's nice to be able to say, hey, there may be other organizations out there that have the ability to do more. At the end of the day, though, I think we'll continue to do all of the tax credits. I mean, I mentioned we haven't done historics in a while. We're probably going to get back into that. But again, maybe not. We'll see what happens. But I don't think there's any chance that new markets tax credits goes away.
And certainly, Steve, your point, and I know it's this way for all three of our organizations. And as we're thinking about how the puzzle is put together, a factor for a positive factor for all of us, I know, on the new market side are the teams that we have in place, the infrastructure that we've invested in over the years to this point, and what we're able to do in partnership with CDEs to be able to impact communities in ways that you're just not able to do with the other credit with the other credit programs, but all of which have merits on their own. This is unique, right? This is very unique, and it's a definite factor.
So thank you for those insights. And Dave, you had noted that the things can change in a heartbeat. And unfortunately, I think we all remember a few years ago when we weren't sure what the corporate alternative minimum tax might be and whether or not there could be some minimum tax that the credits potentially couldn't offset, as well as the impact of BEAT and the rest. And I do remember a end of the year conference where it seemed like there was a bit of a hold on investments as a number of corporations had to assess the impact. So as you look at the various items that I identified, as well as other items that weren't sort of identified in that prior chart, are there some items there that you kind of look at and say, you know, if this happens or that happens, we could end up seeing some sort of a potential reassessment? Because as Congress starts to pass this legislation, you know, presumably the institutions that you work at have to respond, and they have to decide, you know, what impact that has. And there's various layers in terms of how they respond. So how that dynamic evolves as we kind of head into the fall, into early next year. Do we look at it and think, boy, it's probably just a question of only potentially getting more authority? Do you look at it and say, well, you know, depending upon, you know, if it goes in a direction we're kind of expecting, then there's a potential that it could adversely affect our demand? It's a bit of trying to, you know, guess into the future, but given that what the experience we had before that came all of a sudden, I thought it'd be a worthy question. I also like to invite those that are viewing, you can submit questions to the Q&A pane. So if you have particular questions or threads you want Ira and I to follow up on, please submit a question.
Well, I mean, I would just, a quick comment I would make is I feel like, I mean, time will tell once we get through all of this, but it feels like we've done at least right now, it feels like we've done a really good job of learning from the experience of 2017 and preemptively advocating for, let's make sure whatever sort of special surprise piece of, you know, change to the tax code happens, that the community development credits could be applied against that change, right? We've proactively been out there advocating for that, and I hope that will be helpful and sort of stave off the impact of any sort of potential surprise that could come out. Right? But I do remember that phone call.
Yeah, and I would just say the same thing. I think we've done a really good job of it. I mean, you know, BEAT tax really wasn't an impact for us. You mentioned that one in particular. I mean, there are other things that come into play. We're all constantly analyzing it now. I talked a moment ago about the near constant conversations with our corporate tax partners now. You know, I'm also going through a merger, and there's maybe somebody else on this panel who's going through a merger too. You know, these things happen in the blink of an eye, and they impact things as well. So I would just tell everybody, be on your toes. Because even if it's not industry wide, there can be things that happen at the bank level, everything else that happened. And the good thing, I think, is that we've all done such a good job advocating for this program. Everybody enjoys reading about these articles in the newspaper, but nobody more than the executive leadership at the financial institution. So keep those things going out there. Please keep getting all the projects out to the newspapers and the articles and all of your all's different publications, because we love to share those with our bosses.
Anything to add, Laura?
Yeah, I was just going to add, from my perspective, and I think as a syndicator, the picture generally looks positive. So I would say add them all together, and I think it generally looks positive, particularly with how we're seeing the market kind of settle at this point. I know Dave said earlier, like his gut is that the pricing is rising. So I think that there's kind of you know, we're coming back up a little bit. I think we found our floor and got away from it. I think it will be really interesting to see what the absorption of the $5 billion, like the timing and absorption, and what that looks like in 2021 versus 2022. And you know, there could be timing issues there. And I kind of think at this point, the amount of credits in this year and yeah, I have questions about deal flow and just industry capacity for closing. So just like I feel like we have the right capacity to absorb what's possible for the second half of 2021. But if that capacity and absorption is relatively low, and then you get into 2022 with a large amount of credits and then another $5 billion, like, does that kind of keep pricing soft, or do we see enough appetite, everyone's appetite kind of grow a little bit and kind of keep it at that stable place? Otherwise, most everything else, I've got questions about CRA, a couple of those things, but everything else feels like it will be more positive.
Yeah, and I'll reemphasize what Laura said there about timing. If we're thinking about new markets tax credit awards in August, I mean, we all know how long it takes to get an allocation agreement signed, 90 days. So we're closing deals in November and December. We all have nice teams that have been staffed up, but they can't do everything. So I would say to the entire industry, temper your expectations in terms of how many deals are going to close in November and December this year. And I'm not saying that a lot won't happen. A lot will happen. We're all used to working through Christmas, but we're also all going to be working on an application, right? I am reapplying this year, even though we didn't apply last year. So that is something that I think will play a role in affecting the 2022 aptitude. I think Laura hit the nail on the head there.
Yeah, and I think the industry has gotten pretty good at bucketing demand, right? Like bucketing, how there's going to be a year-end rush, right? And we've gotten pretty good, I think, at being able to capture, say, once awards come out, which deals we as an industry are going to try to close by year end, which deals we're going to try to close by, say, what's going to be maybe end of January, February, or early February QEI, Quilicky threshold, and then everything else after that, right? And so I at least I think when I think about what's going to happen with pricing and demand, I don't really think about it as $5 billion of allocations going to hit the market all at once, so that technically that's going to happen, because we're going to compartmentalize it pretty well, I think, right? And so I think it's about, how will the pricing lay out for deals in each bucket, depending on when the investors are going to have demand for or expecting to have demand for the volume. Layered onto that will be our own staffing and thoughts around industry capacity, right?
So you guys
you mentioned.
Oh, go ahead.
Oh, sorry, go ahead, Ira.
No, go ahead. I was going to move on to another question.
Well, just really quickly, I saw one of the comments from one of the attendees talking about the Quilicky thresholds, and Dave brought it up. I mean, literally, that's why we did not apply last year, because we saw the number of deals and the number of CDs saying, we need your help making sure we can get this deadline, get these deals closed. And we looked at the capacity of our organization when writing our own application and saying, this is what we can do. We can either help a lot of deals get closed, or we can do some deals and write an application. And so we chose to focus on helping as many projects as possible close transactions by the deadline. And I think that the reality is we do that. So I would not tell the CDs in general, don't stress out about those deadlines. We are focused on that, but don't think that we're going to be closing 75% of $5 billion by the end of the calendar year. It's not going to happen.
Understood. So you guys all touched on deal flow. I guess I'm curious if we think about what's in the administration's plan, and they'll call it infrastructure, notwithstanding the fact that may be a little bit of a political football in terms of the definition and what we've heard over the course of today. There is a lot in there about healthcare, childcare, education, clean energy. Are there things in the administration's proposal that change your all's perspective on asset classes, things you want to do differently in light of everything we've experienced over the last 15 months in disadvantaged communities? And the you wouldn't just be you as an institution, but all of your CDE partners, your prospective Qualic B partners. Anything changing about your sort of asset class prioritization in light of what we're seeing in what will become hopefully proposed legislation?
I'll start by saying I don't know that it will necessarily affect asset class other than from the perspective, and we saw this after the ARA legislation in 2009, there were HRSA dollars, right, that came out of that. So you get pools of money that we figure out how to use with new markets, and then you see more of that asset class, right? But I don't think that's going to drive necessarily the change in any organization that has a broader perspective for new markets. That's not going to change necessarily what we look for. I do think, again, kind of moving away from like deal type asset class, the message of the impact of the transaction and understanding the impact, hearing from the CDFI fund kind of what they're wanting to understand better. Like, I think that's I know for our own allocatee, we continue to dial up the expectations of the transactions that we provide allocation for. So just looking at the impact and where the dollars are going and who's benefiting from them and what the likely impacts to the community are going to be, just really a deeper look at the actual impacts, but not a change in necessarily any specific deal type. You know, there are certain types that in this economy, and I would put hospitality, I would put anything spec commercial, right? Those have big question marks on them. But I'm not seeing, you know, something that's going to drive us all to one industry. But I'm sure that there will be programs that will increase certain industries' level of activity for, you know, the next few years.
I would agree. I'd say, you know, the types of properties that might be eligible under the $10 billion community revitalization fund, I think is what it's called. You know, are types of things that are that we see commonly in new markets, you know, community facilities types of transactions. And so one would expect an uptick in available projects that could use the credit. But we might also see those same projects being able to be done without new markets now because of, and maybe more efficiently for those projects. So maybe to an extent it could balance itself out somewhat, right? So we'll just, but again, I agree, like it doesn't necessarily change our appetite for any one particular class. It just might change the types of projects that are available. It may have a swing on the types of projects that are more readily available to use the credit.
Right. So we do have a question from the audience about I had made reference to the OCC CRA regulations, and the sort of final regs ended up, they're suspended, if you will. And the question was how that has affected new market tax credit investment at your institution. And basically, are you going back to status quo? Is it like it was sort of before? Or are you assuming some elements of this regulation process will survive, and or it'll change in some other way that it's affecting your demand? So just in short, what impact has the current status of the CRA regulations, or the evolving status is probably a better way of saying it, impacted your demand?
Not negative. We could start there, right? I think where we are and were sort of in our own CRA cycle, we were at a spot where we didn't think we were going to have to implement anything imminently, even if it all went through. And we certainly had an eye on it, and we're watching the potential impact. And I think the thought was that it could have impacted our demand, just as we're thinking about it in a CRA silo, because there were probably going to be other activities that were going to be that we were already engaged with that were going to be eligible in the investment test. I'm not sure it would have impacted. So the short answer at PNC is no impact, positive or negative, really, because we hadn't changed in the first place. I'm not, but I think it's a net positive for the industry overall. So.
Laura, are you sort of the same?
Yeah, it's the same for us. We haven't been limited to investing for CRA on the new market, for the new markets credits. We have numerous investors that are not financial institutions that we syndicate to, so that's not really the biggest driver for us. I think it is a driver for pricing in certain CRA markets, right? That's probably, particularly in this market, is going to be the biggest effect, or would potentially be the biggest effect.
Yeah, and
then
Mike,
Steve,
not my regular, yeah,
exactly.
not my problem. But at the same time, going back to the prior question, I'll jump on something Laura said, which is what is driving demand. I mean, and this goes back to these other sources of leverage. I mean, I'm sort of jumping ahead a little bit here, so apologies to you and Ira on that. But I think what's driving the deals, the asset classes we're doing now, is where can people get loans, right? Commercial real estate, forget spec retail, it's not happening, right? But commercial real estate is tough. It's hard to get a loan no matter who you are right now. But we take the but-for test very, very seriously. So if you don't need our money, you can, if you can afford this without us, you're not getting our money. And that's where a lot of the commercial real estate projects are getting done right now. We're still seeing challenges in some of the not-for-profit sectors with organizations doing fundraising. A lot of foundations shifted to operational capital versus capital, versus capital raising. And so we're seeing some shifts. We're seeing financial institutions spend a little bit more time getting a little bit more flexible, taking the reins off a little bit on their lending, getting a little bit more open to the idea of investment. Obviously, a lot of our clients had been, I'm going to use the phrase, hoarding cash, right? And some of them are now willing to make some investments, but they're still having to meet certain coverages and things like that. So we're seeing more projects come to life. But I'm going to give a shout out again to our CDFI lending partners, right? They have stepped up in a large way where a lot of the traditional lenders have not been able to in the last year and a half, because they have the more flexible capital. They have and granted, a lot of those funds come from those of us up here, right? We're investing in these CDFIs and then they're turning around and investing that money as well. And so it's a great partnership. And I'd say that the CDFIs continue to play a huge role in making projects happen in the new markets tax credit space. So thank you to all of you all out there.
I think you're up, Mike, with the next question.
Okay. So we did get a question also from the audience, sort of directed to you, Laura, but we'd love to get you all this sort of comment. The question was, Laura, you mentioned that your bank's appetite for new market tax credits have grown, and there's a wider audience sort of developing, and the kinds of project classes that have some volatility. So the overall question to all of you was, have there been other appetite shifts or changes that impact your investment as you think about the changes? And I would maybe a more simpler way that I'd also layer on as you're thinking about how best to respond to the question. What are the types of investment classes that you find you're able to provide the highest equity pricing, or where you have the greatest demand for it?
Demand for new market tax credits through the roof. I'll say that while Laura's been contemplating this, because I mean the truth is that has not slowed down one bit. But we are, but I'm not an active historic investor, and our LIHTC investment platform is still very competitive on pricing. I mean, I talk with them every single day, and we're still seeing very strong space in LIHTC pricing. At the end of the day, though, I mean, appetite shifts are going to be, I honestly think things are going to be more volatile. I think pricing, I'm not sure pricing is going to go up later this year or next year. I mean, I wouldn't be surprised if things don't hold steady for the time being because of the balance of these different factors, because while there is going to be an influx of demand, and I think there are things that come into consideration, which is which of these credits do we need as a financial institution more at this time than another? But I do think that the permanency idea, or not permanency yet, hopefully soon, knock on wood, but the fact that we have a 5-year extension is really allowing us to put more infrastructure in place, allow us to do more. And I think at the end of the day, the more people that come into this space and put more people into the new markets tax credit industry, more investors, more partners, I think that ultimately will drive more appetite to that. So I think that the idea of permanency in this program, a lot of people think it's a nice to have. There are going to be lots of tangential things that happen. I think the impact is going to be a tidal wave. I think you're going to see more efficiencies coming in from the way we close deals. I think the legal, the prior panel was all about legal stuff. I think those panels are going to become crazy once this thing becomes permanent, because there's going to be a ton of demand to streamline certain things. I think that there's going to be a lot more investors. And I think at the end of the day, new markets tax credit, the way we treat it from an accounting perspective, that conversation is going to get sped up. So I think the next couple of years are going to be very, very exciting, and just within the new markets tax credit industry. But that's me. Laura, I'll let you answer the actual question though.
I'm not sure I know the answer. Let me say this. So from a kind of tax credit structure and type investing, we will continue to invest in new markets and historic twin transactions. We are active in the state new market space and state historics. I will say we have probably taken a little bit of our resources that had a focus on historic only transactions and have reallocated them to new markets because we have the stronger syndication appetite. But when you look, so can it go to like how to get the highest price question? I think there are several factors for us. One is we've had a strong racial equity focus for the last 4 or 5 years. Obviously, in the last year, and kind of the ongoing conversation about race in this country and the interest, the bank has made commitments around increasing investment in Black-owned businesses. We are continuing to derive new products around that. So that will be a space where we will go above and beyond, and we have all sorts of different tools and ways that we can support a project, particularly that has representative leadership by a person of color, and particularly Black ownership. And so we have a lot of different ways that we can support projects in that space. I would say then, because we rely on syndication, we do have to keep an average price that leaves it in a syndicatable range. And so that means we can pay more on some and less on others. We will pay more in markets where there is a very high CRA demand, because we know that those will be easier to syndicate at a later point if necessary. So think places like California, other limited markets, transactions that drive the deeper impact, as we've discussed. I think what we're going to see moving into this time frame, maybe this next 6 months time frame, is larger and efficient transactions. So single allocatees making a large commitment to a project to make it happen, rather than dribbling it all around and asking us to close 5 transactions by the end of the year, right? That puts the strain on the ecosystem that is this industry, which we all have, suffer the impacts from. So I think large, efficient, but starting with impactful, and then some look at geography for us is kind of, how we get to the highest pricing. We have some programmatic relationships that will stretch for, but it's about a balance and coming out at the end of the day with a production delivery that matches the appetite, whether it's from the bank or from a syndication partner.
Dave, anything to add?
No, the only thing I'd say, just simply on our side, to the specific question, our historic credit appetite has increased over the last year, and so as that sort of translates into new markets, that means to the stacking question. I think we're certainly increased in the number of transactions that we're looking at with federal historic credits. The state credit, our various state credit appetites is just sort of a state by state thing. We don't syndicate state credits, so we don't really have a sort of off taker. So if there is a state credit available, it really just depends on the bank's appetite for us. But those are things we do, and we're certainly interested in them.
So at the risk, as the hour winds down, of ending on something around GAAP accounting, Steve did mention this idea that maybe permanence means the floodgates open and speeds up the GAAP accounting, the FASB response. Any update, Dave, as to where that is, or thoughts from Laura or Steve as to the value of that effort?
Yeah, the response so far and the stories I've I've been getting from our folks is that it's been positive progress, but you have to sort of, Mike mentioned it well, you have to temper it. It's sort of, you have to imagine a FASB scale, if you will. And it feels like very positive progress if you have very low expectations of when you get an actual result, right? Right. But so far so good, honestly, from the feedback.
I'm happy to report that, I've spoken with our accounting policy people. They're in connection with FASB as well. We're providing, we're supporting this. Like, we think this is really important for the industry. So yeah, no news, but still positive. And just, we're supportive of this.
Same for us. And I would say of the things listed on that chart, I think this might be I think this might be the top of the list from your initial graphic of what will help appetite and sustain the value of the credit.
No, I certainly could not agree more. I think getting that positive change would be pretty impactful for the investor community. So maybe for the CDEs out there that pretty quickly, that say 100 or so that end up getting awards, what advice would you give them right now in anticipation of getting an award? And once they get an award, they presumably have a pipeline that they had applied with, and they'll be seeking to get some closings done by various clicky deadlines to try to get some closings done by the end of this year. Should they reach out to you now and say, I'm really optimistic? Should they say, wait till I get my award and then reach out? So maybe whoever wants to take that first and try to make it as actionable as possible.
Yeah, no, reach out yesterday, really. I mean, I think if you're just thinking from a CDE strategy perspective, if you're anticipating an award and anticipating reapplying, particularly as it would pertain to, thinking about your deployment, I think you need to make some bets on projects and reach out and start assembling the parties, right, to be able to move quickly once awards come out. Particularly, I think the challenge, particularly if you're a CDE that maybe wasn't successful in the last round or two, and you're not actively engaged in closing transactions, or you might be able to maneuver between allocation rounds once you get an award. Particularly if you're in that group, I think you might want to be in a spot where you're moving on a pipeline, because you're probably also a little bit challenged by the fact that you're not actively in closing mode and working with industry participants on a daily basis. If you're not out there, I'd start making some calls.
Yeah, 100%. We're having all those calls every day. I know many CDE partners out there on this call and others. We've been having those conversations. But you mentioned pipeline, Dave. I mean, we're combining these calls, to be candid. This isn't just about the new awards. It's also about the application that we're writing. Because, I mean, I don't know about the rest of you. My big advice is we've started our application, right? I'm sure most of you all are thinking about it if you haven't already. I've got, the last application we wrote printed out next to me. It's got notes all over it. So that we're combining those conversations, thinking about what happens when the awards come out, but also thinking that as we're being told by the CDFI fund, the application is going to be coming quickly. And so, two birds, one stone, as it were.
Good observations. Laura?
Yeah, I'll just add, be reasonable in your expectations for what's going to get closed. Don't show up in November with 5 deals that need to close by the end of the year or some date that's soon thereafter. And I do think, and Dave, I think you're kind of saying this, like, pick your horses and maybe get your allocation into a couple of transactions. I think that would be good for the industry. I think I'm interested in seeing the dynamics of how allocation gets deployed with $5 billion. Do we see more organizations going towards a larger amount per transaction? That, questions like that I think will be interesting to see. Will we see, I do believe we'll see a higher average deal size, right, particularly in this 6 months, I think, where, maybe the gaps are bigger for individual transactions, but I also think CDEs will be likely to add the $2 or $3 or $5 or $10 million of allocation to make a project move rather than wait for the next piece to come in, and maybe we'll see that equate to higher transaction sizes, larger transaction sizes.
Sorry, we have a couple of minutes left. Did you want to follow up with a closing question, or?
I think we've covered a lot of ground. I'm not sure we've got anything left that would be a short response. I would suggest maybe that your graphic might be something we share with the audience. If we can make that happen, I think it frames nicely for people kind of where we are. So I would just suggest that maybe that would be a good follow-up.
Go White Sox. I mean, why not give a plug for my favorite baseball team?
We can give it a baseball team.
Yeah. You know me. Go Giants. Best record of baseball.
I'm sitting here in Baltimore, guys, so we'll skip
tied for the
baseball.
best record in baseball with the White Sox.
Yeah, yes, they are. Any other last minute questions or comments? Well, thank you all, and thanks to participants. I think we hand it over to Yvette now.
Thanks, guys.
And Bob.
And Bob.
I